the time may never be better for those looking to purchase a home, apparently. Mortgage rates falling to the lowest level since the beginning of the year. Consumer credit companies are making it easier to qualify for a loan. New rules and formulas are raising the credit scores of up to 12 million Americans. We want to bring in Collingwood Group Chairman and former Fannie Mae executive Tim Rood right now. Tim, good to see you. Thanks so much for joining us. So the consumer credit card companies, are they doing something different right now in terms of why we're seeing these higher scores?
So what's happened over the last decade, mostly in the last 3 years, they've fallen under a lot of scrutiny. You think about Experian, TransUnion, Equifax, the companies that produce these FICO scores ultimately. The scrutiny has been look, you guys have not been very responsive to consumer demands, that these reports are inaccurate, and these inaccuracies are hard to correct, and therefore people have suffered. So the first installment of the changes essentially have been look, let's suppress some of these things, civil judgments, tax liens, and things like that the borrower had or the customer had no idea that were even there, and quite frankly, the documentation doesn't support it. That's only step one. The bigger step is the fact is that the government, all the housing agencies that are using these FICO scores as some proxy for creditworthiness and capacity, these things are so outdated. It's kind of like the government is using, Atari consoles when the new generation millennials are using Pokemon Go and Instagram and things like that. So there's 50 million of these people that are unscorable and that are completely invisible to the system. That's going to be the bigger issue that needs to be addressed.
That is a big issue. How would you characterize the business right now in terms of buying a home? Is it a buyer's market?
It's definitely, look.
Even though prices are way up there.
It's a difficult conversation only because it's local, right? But certainly it's a seller's market for anybody who's in the market. But you have this whole catch-22 right now where there's not enough people selling because there's nothing to buy, and nobody can buy because there's nobody selling, right? So there's one of the things and the ideas around this expanding the credit box so that you have more people that are eligible to buy, loosening the credit box, if you will, is that you're going to have that more demand, and that more demand is going to stimulate more sales, and then ultimately that improves the velocity and the turnover of the housing market where we're really challenged.
Does that mean what's going to happen to costs of houses if we get more going on? And as rates are rising, does that mean that home prices are going to come down so people will afford less?
Sooner or later, something's got to give, right? I mean, because right now you have home price appreciation that's outstripping income. So that only works as long as rates keep going down and keep making properties.
Growth.
Right. Yeah. So you have wage growth that's around 2% if you're being generous, and you have home price appreciation at 6% a year. The only way that you can support that is, of course, if rates somehow keep dropping and making these more affordable. Otherwise, it breaks, and ultimately you're going to see home prices stall. And obviously, if you run out of inventory, that creates another separate problem. But something's got to give. You've got to see the appreciations drop, or you've got to see incomes go up.
You're starting to see that in San Francisco, actually.
Oh, for sure, yeah.
Finally, where the market just gave way because the homes there were so unaffordable.
Yeah, there's a lot of markets like that.
Yeah.
What do you want to see at Fannie Mae? I mean, we're hearing from Stephen Mnuchin, Treasury Secretary, that this is one of his priorities, whether it be privatizing Fannie Mae and Freddie Mac or doing something to get those mortgages out of that control and more into the private sector. How do you do that easily? You worked at Fannie Mae for how long?
Well, I mean, so they're in their 9th year of a timeout, right? So Hank Paulson called it a timeout. Well, obviously, they intended it to be a short-term solution. It's one of these kind of vexing issues that's difficult to get out of for a number of reasons. One, because they control about $5 trillion worth of mortgage debt. So the idea that even if you were to sack those companies and get rid of them, then what do you do to the bondholders of that debt? The other issue is, of course, is that they're throwing off cash. I mean, it's like a two-headed monster that's just coughing up $100 bills when you've got budget deficits and issues associated with generating revenue and things like that. I mean, they've thrown off $80 billion in excess on top of what they've already borrowed from the government, yet they still owe the $187 billion. So on some level, it's a little bit of a solution looking for a problem, because markets are well served. It's their job to be in every market every day and providing liquidity.
Why change it?
I don't know. I mean, this is not one of these issues that's being driven by public opinion, right? You don't have people climbing the White House fence clamoring for reforming Fannie Mae and Freddie Mac. You don't have the Wells Fargo executives picketing, something like that. So it's going to be difficult to see where someone would get the political will and really the urgency to do something.
We'll be watching the situation. Tim, great to see you. Thanks so much. Tim Rood joining us there. Coming up.